Listen to me. If you are in your 80s, or if you love someone who is, I need you to open your ears and hear me loud and clear. There is a huge, dangerous myth going around out there that once you hit 80, your tax planning days are over. People think, Susie, I'm 82 years old, I'm living on my pension and my Social Security, I'm taking my required minimum distributions every year like the IRS tells me to, so why should I worry about taxes now? I will tell you why you need to worry, because if you do nothing, the IRS is waiting in the wings to take a far bigger bite out of your hard-earned money than you ever dreamed possible. When you turn 80, the IRS formula for your required minimum distributions, your RMDs, starts accelerating fast. The percentage of your tax-deferred IRA or 401k that you are legally forced to take out every single year goes up. That means your taxable income spikes, even if your actual lifestyle and spending haven't changed one bit. And what happens when your income spikes? It triggers a domino effect that ruins your retirement peace of mind. First, it pushes you into a higher federal tax bracket. Second, it can make up to 85% of your Social Security benefits subject to income taxes. And third, this is the one that catches people off guard and makes them furious, it triggers Medicare IRMAA surcharges. That means your monthly Medicare Part B and Part D premiums shoot up simply because your forced RMD made you look richer on paper. You worked 40 or 50 years for every single dollar in those accounts. You saved, you disciplined yourself, you delayed gratification. You did not build that nest egg just to hand a giant chunk of it over to Uncle Sam in your 80s because nobody told you how the rules change. So, what is the fear? The fear is running out of money, losing control of your health decisions, or leaving your children a massive tax headache when you pass away. Because remember, under the current tax rules, when your non-spouse kids inherit your traditional IRA, they usually have to pull every dime out within 10 years, often right during their peak earning years, and get slammed with income taxes. So how do we fix this? What is your actionable takeaway today? Number 1, Qualified Charitable Distributions, or QCDs. If you are age 70 and a half or older and you give money to a qualified charity, church, or nonprofit, stop writing checks from your personal checking account. Instead, send that money directly from your traditional IRA to the charity as a qualified charitable distribution. Why? Because a QCD satisfies your required minimum distribution up to $100,000 plus per year, but it never touches your adjusted gross income. It lowers your taxable income, protects your Social Security from extra taxes, keeps your Medicare premiums low, and supports causes you care about. It is hands down the single best tax break available to retirees over 80. Number 2, look into tax withholding directly from your RMD. Stop stressing yourself out writing quarterly estimated tax checks to the IRS. Have your custodian withhold your tax payments directly from your distribution so you stay compliant without the anxiety. Number 3, think about your legacy. If you don't need all your RMD cash to live on, don't let it sit idly in cash getting eaten away. Pay the tax, move it to a taxable brokerage account or a Roth position, and position those assets so your family doesn't face a massive tax trap down the road. Age 80 is not the end of tax planning, it is the moment you must stand up, take control, and protect what is yours. You stand tall, you get smart, and you protect your money.